US consumer confidence rises while Australians grow gloomier. Rising rice prices are expected to feed into Vietnamese inflation, and Aussies are drinking cheaper booze. We look at what that might tell the RBA. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Head of G3 Economics, Brian Martin, explains how car insurance costs in the US have been causing problems for headline CPI inflation and what that could mean for the Fed.
If you've got a shift in the component of an economy between supply and demand, or you've got a regulatory issue driving policy which is affecting pricing, monetary policy is going to really struggle to address that.
But first, in 5 and 5 with ANZ, global stock and bond markets were generally steady overnight as traders kept the focus on US inflation data due later this week. Yields on US Treasuries were up 2 to 6 basis points, while the S&P 500 was down 0.8% at 4 a.m. Sydney-Melbourne time. The Nasdaq was up 0.5%, approaching a new record high. The Aussie dollar was flat at 66.51 US cents, while the Kiwi was down just a touch at 61.44 US cents. In the US, a soft Treasury auction supported bond yields, the 10-year up over 6 basis points. Minneapolis Fed President Neil Kashkari said rates should be held for as long as necessary, citing elevated wage growth as hindering progress on inflation. The Conference Board's Consumer Confidence Survey was mixed in May, with headline confidence rebounding after 3 monthly falls. But fears of recession are increasing. Here's ANZ economist Bansi Madhavani.
Consumers' assessment of both present conditions and expectations improved, supported by robust labour market conditions. What is noteworthy is that on a 3-month moving average basis, consumer confidence continues to remain in a narrow range where it has been hovering for the last 2 years. But the data broadly affirms that US consumers are in healthy shape, even as there are lingering concerns around medium-term inflation outlook and possibility of recession.
Number 2, consumer confidence in Australia dropped 1.8 points last week, back to its 2024 low, according to the ANZ Roy Morgan survey. ANZ senior economist Blair Chapman says it was a surprise to see the drop happen so quickly after the federal budget.
We got that 1 week bounce and then we were back to the same levels we were 2 weeks ago. And I think inflation expectations picked up. Current financial conditions picked up slightly, but future financial conditions sort of really declined quite a bit. And then so did the sort of short-term economic confidence. So I'd say overall a really sort of weak consumer confidence print this week.
Number 3, Australian retail sales were a touch weaker than expected in April, rising just 0.1% for the month. Spending was weaker across most retail categories, including for alcohol, with the Stats Bureau noting people are increasingly substituting for cheaper alcoholic products. Here's Blair on what all that means for the RBA.
Both consumer confidence and retail sales are suggesting that the consumer isn't super confident. They're not going to be out there spending. They're looking to save as much as they can and sort of make sure their budgets are in line. And I think the RBA's looking for exactly that. They don't want the consumer out there spending a lot.
Number 4, Australia's April consumer price indicators today are expected to show annual inflation easing to 3.4% from 3.5%. ANZ senior economist Catherine Birch says April typically delivers a solid print due to seasonal rises in things like clothing and footwear.
Being the first month of the quarter, there are price changes captured for a much higher share of goods and tradables compared with services and non-tradables. So this data won't accurately reflect where domestic price pressures are. So while it will provide some information content, it's unlikely to really shift the dial this early in the quarter.
Number 5, Vietnam releases its inflation data for May later today. ANZ economist Arindam Chakraborty says inflation has been on an upward trend since the start of the year, testing the National Assembly's 4 to 4.5% target range.
We think that CPI inflation will accelerate to 4.6% year-on-year in May, driven mainly by high food and foodstuff inflation, while transport inflation is likely to remain elevated. So rice prices in the international market have begun to surge again in May, and Vietnam being one of the major exporters of rice, these higher prices could seep into domestic inflation. Also, housing inflation is likely to remain elevated amid tighter inventories.
Arindam Chakraborty there. Now, in our bonus deep dive interview, we talk with ANZ's head of G3 Economics, Brian Martin, about how rising car insurance premia are boosting the US CPI and how this might be interpreted by the Fed.
The motor vehicle insurance component, which has a weighting of just under 3% in the index, rose a very strong 22.6% year on year. It is therefore a significant contributor to the headline inflation rate in the United States. I think of the overall CPI, or what we call the headline CPI, it contributed 0.6% to that in April, and that's been growing over years. So we've had a look at why is that the case? What is going on here? Because this is really an issue that is contributing, we think, to the stickiness in services and in particular supercore inflation in the United States. I think one of the reasons you've got to ask yourself is why is this happening? And we think climate policy is playing into the answer. We know governments across the globe are targeting net zero carbon emissions by 2050, and a key area of that is trying to limit the emissions from the auto sector. So we're having a shift towards electrification in the United States. We're seeing it here in Europe as well, as indeed elsewhere in the world. And that's affecting the relative price of insurance. Replacement parts for electric vehicles are less available and more expensive than they are for internal combustion engines, or ICEs as they're called in abbreviated terms. And they also have batteries rather than engines, and if a battery gets injured in a minor collision, the replacement cost of that is very high. In fact, EVs can often be scrapped if the batteries are damaged, and all that is just pushing up the cost of premiums going forward. So we're seeing a relative price shift because it is more expensive to insure EVs, which initially generally tend to cost more than internal combustion engine cars do anyway. And that's not going away anytime soon. We think that's one of the factors contributing to high auto insurance in the United States and therefore contributing to the sticky CPI.
Is it possible for central banks to look through this sort of structural shift? Because you obviously can't change the climate or this move to electrification with monetary policy.
Absolutely. So one of the, I think, rules of thumb of monetary policy is that it doesn't really address relative price shifts. It can address absolute price changes because they can often be driven by monetary policy. But if you've got a shift in the component of an economy between supply and demand, or you've got a regulatory issue driving policy which is affecting pricing, monetary policy is going to really struggle to address that. So what do policymakers do? We actually looked at that in the note that I put out, and we stripped out car insurance to see what's going on with underlying inflation. And underlying inflation, interestingly, is improving. The improvement has slowed, but it has not stalled. And in fact, you're a lot further down the line towards returning inflation to target. We calculate that ex motor vehicle insurance, the US core CPI is 2.9% and not 3.6%. But policymakers can't ignore such a large and important service that consumers need to buy, nor can we as analysts. So what are they going to do? I think it means that they've just got to be patient. I think they've got to look at the broader complex of inflation and say, okay, well, this is one thing that is telling us that excluding that monetary policy is probably restrictive. So if we do sit tight, this will come down.
Brian Martin there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, May the 29th. Catch you tomorrow with reaction to those Australian inflation figures. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.